And joining me on the podcast and on video, it's Dan Lane, Lead Analyst at Robinhood UK. You're right, Dan. We haven't spoken for a while.
I know, not too bad. Good to see you again, Justin. How you doing?
Yeah, I'm okay. Well, I've just been boring you about my house renovation, which is driving me nuts. But hopefully this time next week I'll have a proper working kitchen with water and everything, which I haven't had for
Yeah.
8 weeks. So that's like a luxury, just having running water in the kitchen. For now, I never thought I'd miss a dishwasher in my life, but I am.
Oh, first world
Anyway.
problems. First world problems.
So before we get into this, Robinhood, of course, is very well known, and in the US, and it's done superbly well. And I've been following the stories coming to the UK and stuff. So, is it fully launched in the UK now? Tell us a little bit about it, if you could, Dan.
Yeah, absolutely. I mean, I think a lot of your listeners and viewers will probably know us from the US, but the reality is that Robinhood has a global mission. So there's 24 million users in the US, which is huge numbers,
Yeah.
and they're loving like the commission-free element of the app, and the fact that there's no minimums, and we're really trying to democratize finance for everybody, and that
Yeah.
means beyond US borders as well. So we're really happy to be in the UK. Been here for around about a year. We've had lots of really good feedback. So yeah, we can use the app to buy your US stocks, and you have to start somewhere, but we really want to build out this product suite. So yeah, watch this space, but definitely give the app a go, have a look at it, and see what you think.
Yeah. And so it's US stocks at the moment only, but there is ambitions, to trade UK, European stocks. Is that right?
Well, I think our CEO Vlad Tenev, he's been going on all the media and talking about how localizing these products and everything. So I think goal one is get it looking like what the customers love in the US,
Yeah.
and then beyond that, let's look at what our localized customers need. So it's a really exciting time, I have to say. I've been a user for a long time, so yeah, nice to get in front of you wearing the Robinhood jumper.
Yeah, yeah, yeah. Well, do you know what, though? I mean, the way the US markets are, there's no need to trade the UK markets because they're terrible. It's like, that's all and it's almost like it's momentum as well, isn't it? When you see market to market doing well, it just sucks more money in, and I know a lot of people saying, oh, forget AIM, forget UK. But there again, we do have cycles. The markets are cyclical, and it will come back, in the UK. And I think, in fact, when everyone is talking about one market, the boat is sort of it's heavy in it on one side pretty much. So, yeah, but yeah, there's still plenty of you know opportunities in the US, but I think there's also the opportunities now, UK, Europe. So, yeah, but it's almost like I wish I'd gone. Hindsight's a wonderful thing, isn't it? But I mean, it's almost like going big in the US, like a couple of years ago would have been the thing, and now you're thinking, can they still keep going up? They are still keep going up. It's like phenomenal. Some of these, the big stocks, the Mega Seven, whatever they're called now. But
Yeah,
yeah, okay. But
yeah. I
let's
mean,
go on.
oh, sorry, I was just going to say. I mean, valuation discount in the UK is just it can be so appealing. But unfortunately, I think the last time I spoke to you about 18 months, I think we were both saying the same thing.
Yeah. Yeah. Well, the thing is, if you look at the AIM market, it's pointless as a market to invest in as a whole. The AIM all share market, because it's a stock pickers market. There are some great businesses on AIM. Trouble is, uh, you know, uh, it gets tainted because there's a lot of rubbish companies. Well, it's a startup market, and so what you have by the nature of a startup market is a lot of failures. They tend to gain press coverage and the highlights and the headlines, and then people just assume entire aims at that, and it's not because do you know what? Like I said, my website, I look at the microcap league, and I only focus on profitable, growing companies, and they're all from AIM pretty much. And so there are some excellent businesses on AIM, but they do get overlooked and because you get all these rubbish sort of resource stocks or companies going bankrupt, to grab the
Yeah,
headlines. So it gets tainted a
yeah.
bit. But there are some great businesses on AIM, absolutely. And there's, like I said, some brilliant entrepreneurs in the UK, but it seems at the moment everything's favouring the US. But we're going to be looking at some small caps on our podcast. So what are we starting off with today, Dan? Is it a quality business or is it a bit of dross?
Well, I mean, it's interesting. We've got three businesses we're going to look at.
Yeah.
Couple of turnarounds, actually. I think that's probably the theme of the day. I mean, obviously, before I begin, nothing I say is advice. It's just guidance and just
No.
Dan's reflection on
Yeah.
the markets more than anything. But I
Yeah.
think the first one we'll kick off is Mulberry. So I think before we
Okay,
started,
let's look at the
yeah,
chart. Yeah, let's look at the chart. Is a chart here of Mulberry, and yeah, it's not looking good. This is a chart scrolling back here from well, let's go back to 2021. It was 380 a share. In fact, it's not. I've seen worse shares than that. It's a quid a share at the moment. So what's happening here, Dan?
yeah. So I mean, yeah. Before we began, you were telling me about your extensive Mulberry handbag collection, and
Yeah. Oh
yeah,
yeah.
absolutely. It's this heritage brand in the UK, and I think we will probably keep going back to the likes of Burberry in this sentence as well. It's struggled over the past few years. Mulberry. People are trying to think what space does it exist in? Is it pure luxury? Is it kind of has it been tainted who the market is? The reality is it has really struggled because China has struggled. It
Yeah.
had results this week, and its Chinese sales more than halved. Its gross margins are really, really impressive, actually, at around 70%, but they've now
Yeah.
slipped to around 66. Now, when you've got gross margins at 66 and your retail revenues falling and your pre-tax loss of 16 million, that's telling you what the operating margins are looking like, and that's really not going to be healthy. So story's not great. And they've recently had been fighting off bids from, Mike Ashley has been, and the Fraser's Group has been really, really up there. Um, but the point is, it's not reaching the iconic status where its reputation is bringing it forward. You're still buying a handbag for £1,000 on Mulberry, and I was speaking about it in the office the other day. Apparently, the Alexa model is the one you want. Um,
Wow.
but
Ironically,
on
in China, you can probably get that bag for 5 quid.
I
You
know,
know?
yeah, yeah. It's but again, going back to like the Burberry thing, the Burberry's turnaround recently was about let's bring it back to basics, let's get back to what we're known for, the max. Let's forget about all the superfluous stuff. And Mulberry,
Yeah.
there's been more comments around that recently. So you go onto the website, there's a frog keyring in leather for £200. Now I
A
don't know if he
what?
needs that. It's just a little green frog for
A
two hundred
frog
pounds.
keyring.
Yeah. Now I
There
don't know who
is.
wants
I
that.
mean, exactly. You say getting back to basics. You're right there. Now, if I went, and bought that for my wife for Christmas, she would just look at me like I'm stupid. And I'm thinking, why have you bought this? It's like, who's that for? You know?
Yeah, exactly, exactly. And it's this type of thing that I think when companies get a little bit nervous, especially in like the luxury space, they think we'll just make it and someone will buy it. But you don't go to Mulberry for things like that. You don't go to Burberry
Frog
for a
keyrings,
bag.
no.
Yeah, yeah. I mean,
No.
somebody must have bought them, but they're not selling out. But this
Yeah.
return to core product is really part of these turnaround plans. Now, the only thing is, I was watching the shares after they released the RNS. The market just wasn't convinced. They've got this new CEO, Andrea Baldo, who had, just good pedigree. But the whole point of getting back to basics, does the world need Mulberry again? I don't know. There's part of this turnaround plan is like really slimming down. Unfortunately, that's going to mean a lot of job cuts, trimming down unperforming stores in China. But once you get back to that, where's the growth coming from? Because it was China,
Mm.
and if it's not China, do we think that the UK customers are going to start spending this? They're in a tricky spot. They really are.
Yeah. Well, I mean, if you look at it, you got, group revenue down, what, 19% to 56 million there. These are interims, are they? Half year?
Yes,
26,
first half.
26,
Yeah.
yeah. Yeah. And then you've got debt. I was looking at the debt there. They got debt about 32 million. And
Mm,
you're thinking that's half the market cap. It's literally you got to say when I invest in a business, because a lot of people focus on share price too much, but when I invest in a business, is this business improving? And I'm thinking, no, it's not. I mean, and it
yeah.
doesn't seem like there's any signs of it yet improving. It may be a recovery play, but there's no signs of that recovery play happening. And I shouldn't pin their hopes on frogs. I was going to say, thing is, I don't
Well,
really
yeah.
know. I know Mulberry's for bags, but I don't really know what stands out. Burberry, I can sort of see it in my head. It's a very strong brand. And Mulberry, I think they should have accepted the offer from Mike Ashley. What is Mike Ashley doing anyway? Every struggling business you want to buy, it's like he's trying to get. It's like he's playing, at Christmas time Monopoly. You just try and buy everything. It's like he's doing that, isn't he? I don't understand what you know, his strategy is, but he's obviously a bit of a genius. But see, any retailer is in trouble. He's buying, as you can see him on, buying them and thinking, what is he doing? It's like if you get a load
Yeah.
of bad businesses together, does it make one good business? I suppose he's using the network and the IP they've got and whatever they have and the brands. I don't know, but yeah, it's almost like an evil genius,
Yeah.
isn't he? You know?
Well, it's opportunism, isn't it? And
Yeah,
the difference is, so the last offer came in at 111 million. Um, Now Burberry's largest shareholder didn't want to take that offer. But what
mm,
it does now is it puts a whole lot of pressure on this turnaround, and if the
yeah,
turnaround doesn't come off, there's the price. There's the ceiling. There's the 111 million that you didn't accept, and you might not get the same next time. And you know what? It's
yeah,
probably not the last time you'll see Mike Ashley. A little bit of opportunism come and say, "I wonder if I can snap this up."
yeah. I don't know what price you offer, but look at that. It's a they are for the half year a loss before tax of 15 million, 15.3, up from 12.3. You got
Yeah,
debt of 32 million. I'm thinking, so, maintaining a servicing debt when you're making a loss. If you're loss making and the loss is increasing and your debt's getting bigger and your sales are going down, that's not a good combo. So,
no,
yeah. So any idea what you offered? So, no, so it
I
didn't
think
say,
I think
is
it
it?
was
Oh,
111. I think it was,
okay. All right. Okay. Cool.
and they've recently had a cash raise.
Yeah, 10
But
million, it said. Yeah.
yeah, I mean, Fraser's stake is around 37%, so that's a strong stake already in the business.
Yeah. Yeah.
All they, I mean, if they really do want it, it's probably, I mean, I can't tell the future, but it feels like they're on borrowed time right now, unless something crazy good happens with this turnaround. Um, but often what I see, and you've seen it as well, is that everyone gets very tight and they pull in the marketing budget and just to save money. But as you just said, you don't know Mulberry; they're not out on the billboards. Arguably, they probably need to spend more marketing money to get out there and increase this. But that's not natural, and that doesn't feel natural to do that.
Oh, look, the last bid was 150 pence a share. Take that and run. It's like
Yeah,
they're a quid at the moment.
yeah.
What are
It's
you thinking of? It's a hard turnaround. This going to be. Cool. Look at this. We believe that the appointment of a new CEO, our new debt facility, and a capital raising announced today will put the group on a firm footing to ensure we are well set up for future growth. It doesn't really. Just having a debt facility and a new CEO, growth is very hard to achieve. It's not easy. Just saying it doesn't mean it's going to happen. It's
yeah.
okay. What's next, Dan?
So one that we're going to look, and I think I actually spoke to you this week, maybe a couple of years ago. This is the artist formerly known as Avon Rubber and Avon
Oh
Protection.
yeah.
This is Avon Technologies. So this is the company, the provider of respiratory and head protection. They've moved into kind of first responder and militaries.
Mhm.
They've kind of had a shotgun approach to products over the past, but it feels like they had, I remember a little while ago, they had a big contract with a US outfit. It was either US Army or Department of
Oh,
Defense.
that's right. Yeah.
I think there was maybe a recall on the helmets, and I think that really
Yeah.
dented confidence.
Yeah.
So yeah, when you're producing protective gear and your helmets are defective, that's a big thing, right?
It's
So
dent your confidence. Yeah, dent your head as well if you don't work. But
yeah, so
I know.
but we've talked about Mulberry just about to launch their own turnaround plan. Avon Technologies are kind of like they're well into theirs, and results this week are really, really promising. Um,
Mm.
so we had profit before tax of $25 million. That's up 81% on last year. I mean that's fantastic. That beat analyst expectations by
Yeah.
around 9-10%. Revenues are up, and the most important thing here for this type of business is that the pipeline of orders is really strong. They've got
Mm.
the U.S. Army, U.S. Department of Defense. Who else have we got? I've written it down here. Um, the UK Ministry of Defence. You've got the New Zealand Navy, the Australian, the German Navy. You've got all sorts of, and the good thing is it's diversified as well. And these are fairly consistent. You're looking at $38 million, 34, 42. These are chunky amounts from different places. So this is really good for diversifying the revenue pool. Um,
Yeah.
Good thing as
Look at
well.
that. Look at that. I mean, every. How different is that to Mulberry? Every
Yeah,
metric here. Like I don't know if it's well. I just my book's coming out soon, but I said, a lot of investing is trying to invest in businesses that are improving, and you can see there because it's a lot easier to do that than try and find a company that's, been down this luck. The share price is down and looking for a recovery play, because recovery plays, if they do happen, they're very difficult. If they do happen, take a lot longer than you expect. It's a very bumpy road. So you may have the share price may go up on one bit of news, then they release news not so good next day. But if you get a company that's constantly improving, you get the share price in uptrend, and it's a lot better to do that by a company. Maybe even if the valuations, stretched a little bit, it's better to investing in improving company, because look at that, double digit every single metric here. From revenue, obviously that's top line, to even profit before tax got 88%, like you said, and even they do have net debt, but even that's coming down from 85 to
Yeah.
65. So and that's sort of reflecting the chart. Look at that recovery in that. Wow, it's come down. Go back in 2020, it was like 45 quid a share. It's still only 13.50, but it did hit. It's 560, almost 6 quid a share just below that. And you can see that it really rallied from October 23. Be interesting to see what they released there, because got to say where there was obviously a very good update. Because in a
Yeah.
few sessions, it went from 6 quid to 880. And
Well,
it's continued to recover, isn't it? Look at that.
yeah, I mean, so the two specific things that really got me, and I really like to see. So they're going through this transformation. They've clearly talked about efficiencies beforehand. That's Mulberry are in the horrible position of just about to implement those efficiencies.
Mm.
Avon's already doing it. We're starting to see
Yeah.
the result of it. So the scrap rate, a lot of what they do, unfortunately, has to go in the scrap heap. That's down by over half, just
Yeah.
because of these efficiencies and a closer attention to what does a customer need and what are we producing. So that's number one.
Yeah, that's
The
exactly efficiency, isn't it? That helps your
Yeah,
margins. That shows the management is paying attention. Yeah, absolutely. Yeah.
yeah. Second thing I really liked was, uh, and I think the market looked past this. That their shares were they were up 5%. They're actually the highest riser in the all share after this came out. But they
Mm.
said that they were cutting the dividend slightly. I mean, they were just trimming it slightly, because they want to bolster the R&D pipeline and transformation. I really like that, because I like when the company's telling me the return on capital employed is so good that we're not going to pay the dividend. We're going to put it back in because we think it's better spent that way. I really like
Mm.
that for a growth company. No one's buying this
Yeah.
for an income play. So I really like when they're doing that. That gives me a lot of confidence.
Yeah. I mean, they did do a trading update on the 13th of October, which was the low here. And
Mm.
they do say, if you look, they say in line with expectations, the stronger H2 reflecting good strategic progress. And so yeah. And so it was a positive update. Yeah. I wish I'd known about the back then.
Yeah.
Well, I wish I paid more attention. I mean, you did mention them. I didn't. I tend to focus on companies sub 100 million market cap, but I don't know what the word on there. If they're well in at the moment, they're 400 million market cap, so there must have been
Yeah.
sub 100 down there. Okay, or
But
half.
this was the thing back then, because they didn't have a diversified revenue stream. But
Yeah,
yes, it was maybe diversified to a certain extent, but certainly there was the bulk of the order coming from the US. And then whenever
mm,
that didn't go well, that you could see in the chart exactly where that hit as well.
yeah, yeah. Look at that. Yeah, look at that. You often have these recovery plays. Some companies, may not recover; they may go bust. But I mean, you can see here, from these gap downs from December 2020, gap down there, it rallied a bit, technical bounce, and rolled over again, gap down again in 2021, gap down again at the end of 2021, gap down again in 2022. And then all of a sudden you hit you're bumping on the bottom here, so it's sort of grinded lower. And then recovery comes on. That's how long from the first almost, that's why recovery plays very hard. Because first of all, you have a bit of a warning, gaps down, and then you think it starts to rally. You think, okay, back on track. And then almost down again. And so this is now. When is this going to recover? Recoveries could take years, and it has here. And like I said, and now they're starting to recover. But so you often get people jumping in. I always say never try and do. I've done it before many times. Try to catch a falling knife and be injured, because it's not worth it. You're better off waiting for an improvement, missing the first 20-30% rise, because when trying to guess the bottom, but then trying to get into the uptrend. In fact, here above 200-day moving average, which is the red line, and that's when it's sort of and across over here. Yeah, so and it's starting to recover nicely now. But they said that's how long a recovery can take, several years. So and one of my flaws, one of my weaknesses is always jumping in too early to any recovery play and not having patience. Oh, it's on, and then realize they release another statement saying it's not as good as we thought, and then go, oh, down again. So yeah, okay. What's next, Dan?
So yes, number three, people might remember this is from the crypto craze first time around. This is Argo
Mm,
Blockchain. This
yeah.
is a crypto miner, and the glory days were kind of 2021 for Argo. That was an absolute rocket up.
Well,
Uh,
can
it,
I say what I did here? Right, I held these. I probably told
oh,
you this before. I held these right back here. I didn't want. I didn't have. I remember actually trying to buy Bitcoin when Bitcoin was about $300, but I couldn't buy it. I didn't know how to do it because it wasn't the platforms you could have now. Like I don't know. Well, Coinbase is the most famous one, I suppose, for crypto.
mm,
But there wasn't any of that. Get a paper wallet and there's a string of letters and keys. And I thought, what the heck is all this about? And I just couldn't figure it out. I wish I had figured it out, and I
well,
just gave up. But next time I bought Bitcoin, it was about $5,000. But I also bought Argo, and I said, right, Bitcoin is rallying. Argo's a miner. They're going to rally too. And it didn't go anywhere for ages. In the end, I sold around about 5 pence. It was about 5 pence. Look at the chart there. It went from 5 pence up to three. Well, it peaked out at £3.40. It's like a 3,000% gain. And I sold literally
yeah.
about 3 months before that. I was so impatient. It's not going anywhere. I didn't understand. Why wouldn't it rally? Bitcoin is rallying, but they're not. But they're mining Bitcoin. I understand. And people say, "Oh,
Yeah.
it's difficulty of mining," but it wasn't. It just took a longer to catch on, and it just took off. But since then, they've loaded up with debt. They always thought Bitcoin was going to be high, and Bitcoin then came down. They got debt then. The price of Bitcoin came down, and they've come into all kinds of financial troubles. And now are they selling? I think they're selling all the not well. They're going to quit mining. I think, aren't they?
Well, it's interesting, and you're right. I mean, it goes back to crypto. I mean, I think the jury's still out on what it is and what it's used for. Whatever, to be honest, whatever your beliefs, it just hasn't mirrored that Bitcoin price. And as you say, once you start to explore that, you find yourself going, well, I don't really know what's happening here. The reality is Argo is the miner, and mining margins have really come down this year.
Yeah.
And something I really wanted to point out that really struck me, kind of the reason I wanted to talk about it today is so mining margins from they released the results this week. They fell 8% in Q3, and that was 58% last year.
Mm.
So I was asking myself, how do you get margins that are falling to that extent? And it's these power credits that these miners can use, and this is essentially there's two ways that they can make money with the main grid. So the grid operators can pay them if they promise to reduce their power usage because they're
Mm.
so power intensive,
Yeah.
or the power that they've already pre-negotiated to buy, they can then sell that back into the grid, maybe when the energy prices are high. It should be said that this is not their main business line. They're a
No.
minor. This all feels
Sure.
like a fringe play, albeit if you're making 58% margin, that's a fantastic play. But it just shows how volatile that is and how unpredictable it is. And if you're still on the downward curve, even when you get these massive plays, it starts to make the primary function look a bit shaky. So I'm not
Mm.
surprised if you've got the crypto bulls who are focusing directly on the coins themselves. And then you've got the other side of it where they're saying, I'm actually not that sure because that company is dabbling in different business areas, especially as you said, they seem to be pivoting as well using the AI label as well. And
Yeah.
the worry is that they then start to hopscotch between what's popular at the moment. Yeah,
Well, I mean, Galaxy, who I think who loaned the money, which is another company, loaned the money, runs their Helios operation, which they've got thousands of computers they're mining. But now Galaxy is pulling out. In fact, I'll show you the wording of this recent thing. But even though they paid the debt back from Galaxy, they still got a bond there of 38 million. Now, their market cap, there's Bitcoin, by the way, 97,000 Bitcoins out. But they've got a market cap of, again, dangerous combination when you're loss making and you literally have a market capitalization of 52 million and you've got debt of what 35 million or 30 million in pounds. So it's three quarters of almost the market cap, and they're loss making. So you realize, revenue from digital odd. But cash flow, let me scroll down here. I think they lost for 20 million or something ridiculous in the last. What do they say here? Yeah, so a net loss of 9.9 for 3 months and 26 million for so net loss of no 39.2 million for 9 months. And
Yeah,
you've got
it's
debt of like 30 odd million, and your market cap is 50. And then what I like to listen this announcement here. This is fine. These are two different areas they're in, different sites. I don't know how to say that. Bay Comu and Helios. Now they own, I think, Bay Comu, but they don't own
hmm
Helios. And so they
yeah,
started off by saying, look at this, high performance computing. They've entered into a non-binding letter of intent with BE Global, a specialist HPC, which is high performance computing solutions, to explore significant expansion at the company's owned Bay Commerce facility. This is for looking at computer applications, data processing, AI, other computationally intensive tasks. Now, AI is, of course, is massive, but compared to normal data centers, AI data centers take 10 times the energy. So I don't know
yeah,
how they're going to afford that kind of energy anyway. But they start this off with a very positive thing. Oh, they're switching to AI. AI is the way forward. It's probably bigger than crypto at the moment, apart from Bitcoin. But they scroll down. There's Helios, by the way, a Galaxy who own this, they're not going to renew the company's current hosting agreement, Helios. So they've been informed by Galaxy they're not going to be beyond this year. So Galaxy's also announced they're going to do HPC. So the company is considering its options for its mining fleet, which is 23,000 of these computers. So essentially, they're going to stop crypto mining at their own facility. Galaxy is going to stop doing it and they're just switching to this and they got a spare 23,000 computers. So what is your business now? What are you doing? You've got a lot of debt to pay. You better sell those computers very quickly. I don't know how when they become obsolete, because of course technology, shoots by, and you get faster computers every year, pretty much. I mean, that's your asset there. But you've got a lot of debt to pay off, and
yeah,
you're not mining, you're not doing anything anymore. You've just got a letter of intent. I don't know how you're going to earn
yeah,
money from that. So
yeah.
very
I mean,
questionable.
listen, crypto was out of favor for a long time. It's difficult to, I mean, we all have short memories when it started. Did you just say it just hit, 97,000? We have
Yeah,
short memories, and there was a bit of a crypto winter for a long time there. But
yeah,
it's those types of times that you have to take stock and say, as a company, how do we avoid this happening again? Signing a letter of intent and exploring these things when you're heavily indebted feels a little bit too late. It feels like the horse is
yeah.
bolted there.
Well, the thing is with Bitcoin is that the higher the price goes, the more difficult it becomes to mine, and so your
Yeah.
costs go up, your energy costs go up massively, and so a lot of crypto miners now are not profitable. They can't do it,
Mm.
and so it's okay if probably the best thing they could have done is just when they were mining it down
Yeah.
here and it was easy, just hold on to it, and rather than just sell it or whatever you need to do. But you probably need to pay the energy costs though. So one thing I think the winner from this, whether it's crypto mining or AI data centers, is energy. Thinking, where's all that energy going to come from? And who's going to benefit from these? I mean, the owners of data centers will benefit, of course, but of course you've got Nvidia pretty much who sells most of the chips to these AI data centers, but they're already risen. You're thinking, where's the next play then? It's energy based somewhere because it is all about energy. It's not going to get any less intense to mine these to either crypto mining or AI data centers. 10 times the power they need compared to normal data
Yeah.
centers, which is
Well, I
nuts.
mean, it begs the question that we need to have these conversations around grid infrastructure. I mean, there's a lot of
Yeah.
smart energy funds out there exploring, is the grid still fit for purpose? I mean, that's a huge question to ask. But
Mm.
when you're talking about, everyone's talking about the AI as the future. If the technology was stunted because we couldn't afford to give it what it needs, that feels like a massive shame. And
Mm.
maybe the questions are about actual national infrastructure here, which is a much bigger question that I can take part in.
Yeah, yeah, yeah. But I do think the way forward, I know there's a lot of people who, especially on AIM, invest in
Mm,
oil and gas stocks, and they're really annoyed because, investment has come out of it, and they're saying it's government's fault and all this stuff. But you've got to follow the money. And to a certain extent, if you're going to power these things, then I think you're better off powering them with renewables rather than fossil fuels, So, because at least you can set these kind of data centers up, say, somewhere, I don't know, Africa or wherever it's windy, and you can constantly, get power from them, and it's renewable. It's unlimited rather than trying to drill for stuff or get stuff out of the ground for it. It just seems like this is a lot more suited to renewable energy than than just fossil fuels and digging out of the ground or whatever. Anyway, marvelous stuff. Thanks for that, Dan. I'll catch up in a few weeks' time. Dan, this lead analyst at Robinhood UK. Check it out. It's now this is the website there. Trade US stocks without commission or FX fees. Sign up right there. Marvelous stuff. Thanks, Dan. Speak soon, fella.
Excellent. Thanks very much, Justin.